Previously, we spoke about the basics of trading. Things like risk management, stop loss and take profit, position sizing, and psychology. But here's the problem. Most traders learn these things separately and then wonder why their account still looks like a Netflix subscription. Money leaving every month? So today, let's bring it all together. We're going to build a bulletproof trading system. One that can survive bull markets, bear markets, and those boring sideways markets that make you want to trade Dogecoin instead. And the secret ingredient? Back-tested data. Think of it this way. Would you marry someone after just one date? Of course not. You'd want to know their history. Do they have stable income? Do they binge watch reality TV? Backtesting is basically checking a strategy's dating history before you commit with your money. Now, before we test, we need something to test. And that means we need a strategy. Building a strategy is like cooking. Everyone thinks they're a master chef, but unless you write down the recipe, no one can repeat it. Trading strategies are the same. They need clear rules. When to enter, when to exit, and how much to risk. Let me give you a simple recipe. Imagine we're watching the top 50 stocks. Here are the rules. Buy when a stock breaks its 52-week high. Exit when it breaks its 52-week low. That's it, simple, clean, easy to follow. It's basically saying, if a student scores above 90%, trust him. If he drops below 40%, cut your losses. That's how trading rules should be. Unemotional and objective. Now comes the fun part, backtesting. We run this rule on the historical data of all 50 stocks, every time it breaks a 52-week high. We buy. Every time it breaks a 52-week low, we sell. We keep track of every trade, just like scoring runs in cricket or goals in football. And then we measure the results. The key stats are net profit and loss. Did it actually make money? Maximum drawdown. How much pain would we have felt? Number of trades? Was it luck or consistency? Win rate and risk to reward. Did the wins outweigh the losses? If two people try a diet and it works, here's the golden rule. The bigger the sample size, the less likely you're fooling yourself. That's chance. If 2,000 people try it and it works, that's evidence. Trading is exactly the same. But here's the catch. Backtesting isn't just about profits. You have to dig deeper. Ask, did the strategy only work in trending markets? Were the gains spread across hundreds of trades? Or did one lucky trade carry the whole system? And most importantly, would you actually survive the drawdowns without throwing your laptop out the window? Backtesting isn't about perfection. It's about knowing the personality of your strategy. Think of it like knowing your friend's bad habits. You don't cancel the friendship, but at least you're not surprised when they're late again. So here's the summary. Step 1, create a simple rule-based strategy. Step 2, backtest it across lots of data. Step 3, analyze the results. And Step 4, make sure it's robust, not just lucky. In the next video, we'll go deeper into proper backtesting. How to clean your data, avoid curve fitting, and stress test your strategy so it doesn't collapse the first time the market sneezes. Because in trading, just like in life, you don't trust someone by what they promise today. You trust them based on what they've consistently done in the past. And that's exactly what backtesting shows you.